Every time you deposit $1 into your bank, you're handing over money that the bank uses to make even more money. But how does that actually work? Most people think banks just store your cash in a vault, but in reality, your bank is a business, and their entire business model is making money off your deposits. Let's break this down. When you deposit money into a checking or savings account, it doesn't just sit there. The bank uses that money to issue loans to people buying homes, cars, using credit cards, or funding businesses. For example, you deposit $1,000. That bank might lend $900 of it to someone else. That's called fractional reserve banking. They charge borrowers interest, often 6%, 12%, or even more. But you might get 0.01% in your savings account. That spread between what they charge and what they pay you? It's called the net interest margin, and it's one of the biggest ways banks profit. In 2023, U.S. banks earned over $500 billion in interest income alone. But interest isn't the only game in town. Banks make a fortune from fees. Monthly maintenance fees, ATM fees, overdraft charges, wire transfer fees, minimum balance penalties. Overdraft fees are especially profitable. Some banks charge up to $35 per overdraft. Last year, banks collected over $30 billion in overdraft and insufficient funds fees alone. That's billions taken from people who usually can't afford to lose it. Banks also use deposits to invest. They buy government bonds, mortgage-backed securities, or even equities. This lets them earn steady returns while assuming limited risk. Let's say the bank invests in a 10-year treasury bond that pays 4% interest. Multiply that across billions in deposits, and you've got a profit machine running 24/7. But here's the kicker. You don't see a dime of that return. Your account stays the same. Meanwhile, your money's working hard for them. Of course, this system isn't bulletproof. In 2008, risky lending and over-leveraged investments led to the worst financial crash in decades. Banks failed, people lost homes, taxpayers funded trillion-dollar bailouts. Fast forward to 2023. Banks like Silicon Valley Bank collapsed from poor risk management and overexposure to interest rate shifts. That's where the FDIC comes in. It insures your deposits up to $250,000. But anything above that? You're on your own. This raises real questions about how stable our banking system really is. So here's the bottom line. When you deposit your money, the bank is free to use it, to lend, invest, and profit. You carry the risk. They collect the reward. In a way, you're not just a customer. You're an unpaid investor in their business. And they've designed it that way because the less you know, the more they earn. So the next time you hear, "Trust your bank," just remember, your money is their opportunity. Want to flip the script and make your money work for you? Then hit subscribe, because we're just getting started. This is Chava Capital, where your financial future begins with the truth.